Bond valuation, prices, yields, and coupons. John is standing in the middle of his newly constructed factory, watching the giant robotic arms assemble the first batch of Stickman Pro keyboards. The factory was funded by the $1 million he raised from his bondholders. However, John's job didn't end the day he received the cash. Every morning, he checks the financial news to see how his Stickman bonds are performing in the secondary market. He notices something strange. Even though he is still paying the exact same 7% coupon he promised, the market price of his bonds is jumping around like a heartbeat on a monitor. One day a bond is worth $1,020. The next, it's $980. To understand why his promises are fluctuating in value, John has to master the art and science of bond valuation. As Brealey, Myers, and Marcus explain, the value of a bond is simply the present value of the cash flows it is expected to pay. For John's bonds, those cash flows are the annual $70 coupons and the final $1,000 face value. To find the price, John needs to discount these future payments back to today. But here is the catch. He cannot use his own 7% coupon rate as the discount rate. He has to use the current market interest rate, which is often called the yield to maturity. This is the rate of return that investors currently demand for buying a bond with similar risk and maturity. John decides to run the numbers. Imagine that since John issued his bonds, the economy has shifted. Other companies are now offering 10% interest on their bonds because the central bank raised rates. A new investor, let's call him Mr. Yield, looks at John's 7% bond. Mr. Yield says, "John, why would I pay you $1,000 for a bond that pays $70 a year when I can go across the street and get $100 a year for the same price?" To convince Mr. Yield to buy his bond, John realizes the price of the bond must fall. This is why John's bond is now trading at a discount, a price below the $1,000 face value. The bond's price will drop until the $70 coupon plus the capital gain of eventually getting back $1,000 equals a total return of 10%. The math follows the formulas John learned in the TVM module. The price of the bond is the present value of an annuity, the coupons, plus the present value of a lump sum, the face value. To find a bond price, we add two parts together. First, take the coupon payment and multiply it by a fraction. The top is 1 minus 1 plus the interest rate to the power of minus time, and the bottom is just the interest rate. Second, take the face value and divide it by 1 plus the interest rate to the power of time. Add those two results together, and you have your price. When John plugs in the 10% market rate for discount rate, the math forces the price down. Conversely, if the market rate had dropped to 5%, John's 7% bond would be a premium bond. Investors would be falling over themselves to buy it, bidding the price up above $1,000 because $70 a year is better than the $50 they could get elsewhere. This brings John to the most important realization of the day. The yield to maturity is the truth of the bond's value. The coupon rate is just a printed number on a piece of paper from the past. The yield to maturity is the actual interest rate that investors earn if they buy the bond today and hold it until the end. If John buys his own bond at a discount for $900, his yield isn't 7%. It's much higher because he's getting the $70 coupons plus a $100 profit when the bond matures at $1,000. John also notices a pattern in the price swings. He has some bonds that mature in 2 years and others that mature in 20 years. He observed that the 20-year bonds are much more sensitive to interest rate changes. When the market rate moves even a little bit, the price of the long-term bond swings wildly, while the short-term bonds barely budge. This is called interest rate risk. Because the long-term bond has so many more future coupons to be discounted, a change in the discount rate has a massive compounding effect on its current price. John realizes that as a borrower, he is safe because his payments are fixed, but his investors are taking a risk every time the market interest rate moves. By the end of the day, John stops worrying about the daily price fluctuations. He understands that as long as his business is healthy and he can make his payments, the market price is just a reflection of the global tug-of-war between different interest rates. He has learned that a bond's price is a mirror of the opportunity cost of capital. If the world offers more, his bond is worth less. If the world offers less, his bond is worth more. With this knowledge, John feels more like a seasoned CFO than a simple shop owner. He knows how to read the signals the market is sending him through those fluctuating prices. He isn't just watching numbers move, he is watching the value of time and risk being recalculated in real time. John turns off the lights in his factory, confident that he finally understands the pulse of the debt market and the true weight of the financial promises he has made to the world.